Hi everyone, today I'm going to present you a presentation on the topic of realization and recognition of income and some types of income. Let's start. Learning objectives. Understand and apply a definition of gross income, who recognizes the income, assignments of income, community property system, types of income, income from services, income from property, annuities. Definition of gross income. Gross income is all a person's receipts and gains from all sources before any deductions. For households and individuals, gross income is the sum of all wages, salaries, profit, interest payments, rents, and other forms of earnings before any deductions or taxes. Gross income for an individual. Example. Assume that John earns an annual income of $100,000 from his financial management consultancy work. John also earns $70,000 in rent income from his real estate properties, $10,000 in dividend from the share he owns at company XYZ, and $5,000 in interest income from his saving accounts. John's income can be calculated as follows. Gross income equals $100,000 plus $70,000 plus $10,000 plus $5,000 equals $185,000. Now we have to determine the difference between gross income and net income. Gross income, as we said above, is the sum of all incomes before any deductions, taxes, and other expenses. On the other hand, net income is the profit attributable to a business or individual after subtracting expenses. If the net income is a positive value, it is a profit, but if it is a negative, then it shows that the business incurred a loss. For an individual, net income is the income earned after deducting state and federal taxes, social security taxes, health insurance, etc. In addition to determining when taxpayer realizes and recognizes income, it is important to consider which taxpayer recognizes the income. This question arises when an income shifting strategy is involved: assignment of income, community property systems. Let's talk about assignment of income first. The court developed the assignment of income doctrine to prevent taxpayers from arbitrarily transferring the taxation of their income to others. The assignment of income doctrine holds that taxpayers who earn income from services must recognize the income. Income from property, such as dividends and interest, is taxable to the person who actually owns the income-producing property. To shift income from property to another person, a taxpayer must also transfer the ownership of the property to the other person. Second, community property system. Community property is the family law terms used to refer to all of the personal and real property that couple acquired during their marriage, which legally belongs to both spouses. When two people get married, they share not only their heart, they share their property, their belongings, their income, and their debts. In the United States, not all states belong to community property law. Here is the list with the state this law applies to: Alaska, Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington. Reporting community property income on federal taxes. Community income is the income that is considered by law to be equal shared by the married couple. Separate income is the income that is considered by law to belong to one spouse. In preparing a separate federal tax return, each spouse will report one half of the total community income plus their spouse's separate income. Community property states normally classify the following as a married couple's joint property: any income received by either spouse during the marriage, any real or personal property acquired with the income earned during the marriage. These include vehicles, homes, furniture, appliances, and luxury items, any debt secured during the marriage. Separate property in a community property state includes all property owned by a spouse prior to marriage, any property obtained by a spouse after a legal separation, any property received as a gift or inheritance during the marriage from a third party, any pre-marriage debts. Effect of divorce in community property. When a couple living in a community property estate, each spouse will receive an equal share of the property and will have an equal liability over marital debts. Now let's talk about the types of income. Sources of income simply mean that where the money came from. For example, if you have a job, the company you have worked for is the source of income. First, income from services. Income from labor is the most common source of gross income generated by the effort of taxpayers. Examples: salaries, wages, unemployment compensation, services, fees, and business income. Second, income from property. Include gain and losses from sale of property, dividends, interest, rents, royalties. Depends on types of income and types of transaction generating income. Income realized from rent. Let's say Courtney owns a condo in town that she rents to tenants. This year, the condo generated $40,000 of rental revenue. Courtney incurred $4,000 in real estate taxes, $2,500 in utility expenses, $500 in advertising expenses, and $2,000 of depreciation. Income realized from rent income. Rent revenue $40,000 minus all expenses $9,000. It will give us net rental income $5,000. Third type of income is annuities. An annuity is an insurance product that provides a tax-deferred fixed income stream for people seeking the security of protected income for life. Also, annuities generate income, and some types of annuities offer growth potential. They are not suitable for short-term investment strategy. This product appeals to people whose objectives include long-term financial security, retirement income, diversification, and property preservation. Exist some types of annuities. Annuities paid for over a fixed period and lifetime annuities. Annuities paid over a fixed period. This is the option with the least risk and the most predictable. Fixed annuities come from generated set interest rate that doesn't vary beyond the terms of the contract. Lifetime annuities, these are annuities that guarantee the income stream for the annuity holder's lifetime. In some cases, lifetime annuities allow for a beneficiary to receive payments after the annuitant's death. With this annuity, the amount of the payment will be set depending on the health and age of the annuity holder. We can calculate the exclusion ratio to figure out the portion of an annuity payout that is not subject to tax. One of the benefits of having an annuity is the annuity exclusion ratio, which allows the account holders to earn their return on their investment tax-free. It can be determined by dividing the initial investment over the payment period. This amount is removed from the taxable income of segment, with anything over that amount taxed as usual. Let's say, for example, you purchase an annuity for $100 with a payments period of 20 months. You'd calculate your exclusion ratio by dividing your initial investment by a number of payment periods, or $100 divided by 20. Each month your exclusion ratio will be $5, and anything over that amount would be considered taxable income. Annuities over a life. For annuities over a life, taxpayers might use IRS tables to determine the expected value based upon the taxpayer's life expectancy. To calculate the expected, the number of annual payments from the tables is multiplied by the annual payment amount. Some annuities provide payments over the life of two people. For example, a taxpayer might purchase an annuity that provides an annual payment each year until both the taxpayer and taxpayer's spouse pass away. In this chapter, I explained the basic concepts of realization and recognition, identified and discussed about types of income. I hope you found this information useful and it will help you to better understand these concepts. Thank you for your attention.